Welcome to the Deep Dive, the show where we cut through the noise to get you truly well informed. Today, we're plunging into a story that's as fascinating as it is complex: Pan American Silver. Can this titan of precious metals, with its, vast resources, navigate treacherous geopolitical waters to become the definitive safe haven investment you might be looking for? Or will the ground beneath its feet, plagued by political risk, undermine its opportunity entirely? It could lead to a potentially binary outcome for investors. For you, our listener, we're going to unpack this intricate balance, offering you a shortcut to understanding this high-stakes situation.
That's right. Our mission with this deep dive is to extract the most important insights from our sources on Pan American Silver Corporation, or PAAS. It's a major player, traded in both the NYSE and TSX. We'll help you understand its core strengths, its significant weaknesses, and the high-stakes environment it operates in, giving you a clear picture of where it stands today.
Okay, and to set the stage, let's nail down some key details. As of August 9th, 2025, PAAS shares closed at just under 32 USD on the NYSE and roughly $44 CAD on the TSX. For perspective, spot metal prices on that same day were soaring. Gold was nearing $3,400 an ounce.
Wow.
And silver was over $38 an ounce. But look, these aren't just numbers. They're driven by powerful forces we'll explore.
Okay, let's jump into part one, Foundations of Pan American Silver.
We begin with Chapter 1. Business analysis. So Pan American Silver is a primary mining company. This means they handle everything right, from finding the metals to extracting them, processing them, and even reclaiming the land afterwards. Their revenue comes directly from selling the metals they produce, primarily silver and gold in the form of doré bars.
Which are basically unrefined metal ingots.
Exactly, plus valuable byproducts like zinc, lead, and copper.
And what's crucial here, I think, is their diversified production. In the second quarter of 2025 alone, Pan American produced significant amounts of silver and gold, alongside those valuable byproduct metals you mentioned, zinc, lead, copper. This multi-metal approach, it acts as a natural hedge. It means they're far less vulnerable if the price of any single commodity dips. It's a crucial built-in stability factor.
Right, and their geographic footprint is also incredibly wide. It spans across the Americas: Mexico, Peru, Argentina, up to Canada, Chile, Brazil. They operate numerous key mines. But here's where it gets really interesting. They also hold the large-scale Escobal silver mine in Guatemala, which is currently suspended due to ongoing community consultations. This mine is a significant piece of their future, but, well, also a major wild card.
Yeah, definitely wild card. And another key metric for any mining company is its reserve life index. This tells you essentially how many years a company can maintain production from its proven and probable, or P&P, reserves. Pan American has impressive silver and gold reserves. Based on their 2025 production guidance, this translates to over 20 years for silver.
20 years, wow.
And about 9 years for gold. The long silver reserve life is a cornerstone that offers, unparalleled long-term production visibility. However, that shorter gold reserve life means they have a strategic imperative. They either need to find new gold deposits or acquire them to maintain their gold output long-term.
Okay, so Pan American Silver brands itself as the world's premier silver investment vehicle, a direct play on silver prices.
Right, that's the branding. But the surprising reality, despite the name and those vast silver reserves, is that gold is currently its true financial engine. Our sources show that gold revenue is estimated to be nearly 4 times that of silver. Yeah. This shift, largely due to a recent gold-heavy acquisition, means that for the foreseeable future, their financial results are much more sensitive to the price of gold than silver. So if you're looking for pure-play silver exposure, you really need to recognize you're investing in a diversified precious metals producer where gold is, well, currently dominant.
That's a key distinction. Okay, moving on to industry analysis. The precious metals market is clearly in a strong bull market right now. Gold prices have hit historic highs, and silver has surged to levels not seen in over a decade.
Absolutely. And this trend is propelled by a confluence of factors: persistent inflation concerns, rising geopolitical instability, and strong investment demand. That demand is coming from both retail investors and central banks who are actively diversifying their reserves. The global precious metals market is projected for significant growth in the coming years, around 7.2% CAGR through 2032, according to projections.
And focusing specifically on silver, its supply and demand fundamentals look particularly compelling. The market is forecast to be in a structural supply deficit for the 5th consecutive year in 2025.
5th year, yeah.
Driven by surging industrial demand. Silver is an irreplaceable component in high-growth green technologies like solar panels and EVs, plus 5G, other electronics.
Mm,
This dual role as both a monetary and an industrial metal provides a really robust demand floor.
it does. But despite this incredibly favorable macroeconomic backdrop, the mining industry faces significant headwinds.
Mm.
You can't ignore those. Key costs like energy, labor, equipment. They're subject to intense inflationary pressures. This makes disciplined cost control a critical differentiator between companies. And furthermore, the industry is under increasing pressure from environmental, social, and governance mandates, ESG,
Right, ESG.
demanding stricter management of environmental impact and community relations.
But perhaps the most acute challenge for Pan American Silver, and a critical point for this deep dive, is the regulatory environment in its operating jurisdictions.
This is truly a patchwork of divergent policies. It creates both opportunities and, frankly, severe threats. In Mexico, for instance, there's a severe threat. The government has imposed a moratorium on new mining concessions, is reviewing existing operations, and has reduced concession terms
Wow.
from 50 down to 30 years. This creates extreme uncertainty for key assets like La Colorada, impeding long-term planning. Peru, on the other hand, presents maybe a moderate risk. The focus there is on formalizing its artisanal and small-scale mining sector, create some near-term unpredictability.
Okay.
Then there's Argentina, which actually represents an opportunity right now. Reforms there are reducing administrative burdens and taxes, creating a much more favorable investment climate for assets like Cerro Moro. So it's a very mixed bag, jurisdiction by jurisdiction.
And it's important to remember that barriers to entry in mining are exceptionally high. That protects established players like Pan American. These barriers include, immense capital requirements, specialized technical expertise, incredibly long permitting timelines, and the complex challenge of securing what's called a social license to operate from local community.
Absolutely crucial.
Essentially, earning the trust and acceptance of the people living near the mines is non-negotiable for long-term operations.
Right. So when we look at Pan American Silver's competitive advantages, they are rooted in its sheer scale, its cost structure, and its unique asset base. As one of the world's largest silver producers, it naturally benefits from economies of scale, gives it an edge in purchasing, accessing capital. Their ability to control costs is also key. Their all-in sustaining cost, or AISC, that's a comprehensive metric, including all costs to maintain production.
AASC.
It's competitive among its peers, which signals efficient operations. Q2 2025 silver segment AISC was $19.69 an ounce, and the guidance for the full year is lower, $16.25 to $18.25. Pretty favorable.
And beyond just costs, Pan American's portfolio of unique assets provides a durable advantage. The La Colorada Skarn project in Mexico, that's a world-class discovery with the potential to deliver decades of low-cost production, could fundamentally transform the company's future.
Huge potential there.
And the pending acquisition of a significant interest in the Juanicipio mine adds another Tier 1, high-grade, low-cost silver asset. That's expected to immediately boost their free cash flow.
Immediately accretive, yeah.
Finally, the suspended Escobal mine in Guatemala. While it's currently non-performing, it remains one of the world's largest and purest silver deposits. Its potential restart represents a significant, albeit uncertain, catalyst for the company.
Okay, let's move into Chapter 2. Management evaluation. The quality of a mining company's management team is absolutely paramount. You know this. Their decisions on capital allocation, operational execution, and navigating those tricky geopolitical challenges directly determine shareholder returns.
Right. The leadership team is headed by President and CEO Michael Steinman. He's been with the company for over 2 decades, CEO since 2016. Strong technical background, PhD in geology. His philosophy seems clear. Acquire high-quality assets and maintain a strong balance sheet to act opportunistically.
His track record on M&A, though, it's a bit mixed. On the positive side, the 2023 acquisition of Yamana Gold's assets was seen as a major strategic success, added significant gold production and robust cash flow.
That gold dominance we talked about.
Exactly. And the pending MAG silver deal for Juanicipio looks like another strategically sound night for high-margin silver. The company has also shown strong organic growth, consistently finding new reserves, like that La Colorada Skarn discovery.
However, this record is significantly marred by the 2018 acquisition of Tahoe Resources. That was over $1 billion. That deal brought the Escobal mine in Guatemala, which, crucially, was already shuttered due to community opposition and human rights violations before they bought it.
A key point.
Years later, the mine remains suspended. It represents a massive, non-producing capital sink. This transaction really raises serious questions about management's due diligence and risk assessment, particularly in complex geopolitical landscapes.
It does.
In terms of crisis response, management is actively participating in a slow, government-mandated consultation process for Escobal, but the outcome remains highly uncertain.
And on safety, the company achieved a commendable record of 0 fatalities in 2023. That was a significant improvement.
That's good news.
However, this progress was tragically reversed in 2024 with 2 fatalities. It underscores the persistent and severe risks inherent in mining operations. It's a stark reminder of the challenges involved.
Okay, moving to capital allocation. Management strategy follows 3 main principles. Invest in high-return projects, maintain balance sheet flexibility with low debt, and return capital to shareholders.
And you can see this strategy in their actions. After the Yamana acquisition, they quickly sold off non-core assets for over $1 billion in cash to strengthen the balance sheet.
Right, deleveraging.
It's exactly. They balance investment between organic growth, like exploration. They spent over $80 million in 2022, and acquisitions, pursuing transformative M&A deals when they see fit.
Their approach to shareholder returns is particularly noteworthy, I think. Pan American has a unique and transparent dividend policy. It consists of a base dividend, currently $0.10 per share per quarter, supplemented by a variable component directly linked to the net cash in its balance sheet.
Which is quite unusual.
It is. It means shareholder payouts align directly with company performance. As a result of record cash flow, the dividend for Q2 2025 was actually increased to $0.12 per share. This is complemented by an active share buyback program, too. They bought back over $31 million in the first half of 2025.
Now, a key metric for evaluating how well a company uses its money is return on invested capital, or ROIC. Pan American's ROIC has been historically weak, which, look, is common in capital-intensive mining and was likely weighed down by the unproductive capital tied up in Escobal.
Right, that makes sense.
However, this metric has shown dramatic improvement recently. It reached 5.19% on a trailing 12-month basis, up from just 2.11% in 2024.
So, more than doubled.
More than doubled. This sharp increase is a direct result of higher metal prices and the strong cash flows from the newly acquired Yamana assets. This raises an important question for you, the listener. Is this higher level of return sustainable through a full commodity cycle, or is it merely a temporary function of current peak prices?
That's the crucial question. Okay, let's delve into Chapter 3, Financial Analysis. Pan American's financial performance has been characterized by strong top-line growth, volatile profitability, and recently explosive free cash flow generation. Its current market capitalization stands at over $10 billion.
Yeah, we've seen significant upward trends in revenue over the past 5 years, reaching nearly $3 billion annually on a trailing 12-month basis, driven by both acquisitions and those soaring commodity prices. Profitability, as is typical for a commodity producer, is highly volatile. They posted a net loss in 2022. But with the surge in gold and silver prices, profitability has rebounded dramatically. They reported record net earnings of almost $190 million in Q2 2025 alone.
Wow, quite the turnaround. Free cash flow generation has also been inconsistent, reflecting the industry's cyclicality. They even experienced periods of negative FCF in 2022 and 2023. However, the combination of higher production from new assets and peak metal prices has transformed their cash-generating ability. Record FCF of $230 million in Q2 2025 shows powerful operating leverage in the current market. Small changes in metal prices can have a huge impact on their cash flow.
And their balance sheet. It's a key source of strength. Management has deliberately maintained a conservative financial posture. That ensures resilience through commodity cycles and provides the flexibility to act on strategic opportunities.
Absolutely. Their leverage is incredibly low. The debt-to-equity ratio was just 0.16 recently. It means they have very little debt compared to their assets. Imagine owning your house almost outright. That's kind of their financial position.
Good analogy.
Liquidity is also exceptionally strong. Current ratio over 2.9, over $1.3 billion in working capital. Plenty of cash and readily convertible assets on hand indicates a very robust financial safety net. Allows them to comfortably fund their operations, exploration, and shareholder returns without straining resources.
Okay, so when it comes to valuation analysis, valuing a mining company is complex. You need a blend of relative and intrinsic methods. On a relative basis, Pan American Silver appears inexpensive compared to its own history. Its current trailing price-earnings ratio, around 21.7, is significantly below its long-term average of over 50.
Big difference.
Huge difference, suggests a discount. And this discount is likely a direct reflection of the market pricing in those heightened geopolitical risks, particularly in Mexico. Compared to its peers, its valuation is mixed. Some metrics look cheap, others less so.
Okay, so for an intrinsic valuation, a discounted cash flow, or DCF, analysis is probably the most appropriate tool. Think of a DCF model as trying to guess a company's true value today by peering into its future, estimating all the cash it will generate, then bringing that money back to present-day terms.
Right.
For a miner like Pan American, this means inputting conservative long-term commodity prices like maybe $2,200 gold, $25 silver, not today's peak prices,
Right.
as well as production forecasts and operating costs.
Exactly. And the most critical and frankly subjective input in a DCF model for Pan American Silver is the discount rate, the WACC, or weighted average cost of capital. Given the severe and well-documented geopolitical risks, a standard discount rate, say 8–10%, probably isn't sufficient.
Not enough compensation for the risk.
Precisely. A much higher discount rate, maybe in the range of 12% to 15%, would be necessary to adequately reflect the risk that future cash flows might be impaired by government actions. It's like adding a significant risk premium to your required return.
So what does this all mean for valuation? Well, an educational DCF model built on these assumptions would likely yield a wide range of values. The output would almost certainly show that the stock is significantly undervalued if you believe the geopolitical risks are overstated and use a lower discount rate. Conversely, if you apply a higher, more risk-appropriate discount rate, the model would likely indicate that the stock is fairly valued or maybe only moderately undervalued, suggesting the market's current price has already accounted for these substantial risks. It truly hinges on your personal view of that political uncertainty.
It really does. Now let's move into part 2, market dynamics and future prospects.
Okay, we begin with Chapter 4, Market Sentiment. Market sentiment towards Pan American Silver is truly a study in contrasts. You've got this bullish price momentum clashing with, well, cautious analyst outlooks.
Yeah, Wall Street analysts appear to be tempering their enthusiasm with a heavy dose of realism regarding that jurisdictional risk. The average one-year analyst price target for PAA, interestingly, is actually below the stock's current trading price of around $32. It's closer to $27, $28.
Below the current price.
Below. This disconnect suggests that while analysts acknowledge the company's strong current performance, their models are heavily discounting future cash flows due to that political uncertainty, especially in Mexico. Despite these cautious price targets, the consensus rating remains a buy or moderate buy. Kind of a mixed message there.
Right. Recent news flow, however, has been overwhelmingly positive, dominated by reports of record earnings, record free cash flow, the strategic acquisition of the Juanicipio stake, a dividend increase.
All good news.
All good news. This has created a very positive media tone. Sentiment among retail investors on public forums, though, seems more mixed. Some express frustration over past M&A decisions like Tahoe and maybe long-term share price underperformance. The broader market environment, though, is supportive. Precious metals as a class are in favor. Significant investment inflows into ETFs, driven by safe haven demand, inflation, geopolitical concerns.
Right. And if we look at the market indicators, the technical perspective paints a pretty bullish picture for the stock's recent performance.
That's right. The share price is trading firmly above both its 50-day and 200-day moving averages. Those are around $29 and $25, respectively. Furthermore, the 50-day average is now above the 200-day average. That's a classic technical buy signal known as a golden cross.
A golden cross, yeah.
Indicates strong positive price momentum in the short and medium term.
Now, short interest, which measures the percentage of shares sold short by investors betting on a price decline. It stands at a moderate level, around 4.65% of the float. This isn't high enough to suggest extreme bearishness, but it does indicate that a meaningful contingent of market participants remains skeptical of the stock's prospects, or perhaps hedging bets.
So this reveals a clear divergence, doesn't it? The stock's price action and technicals are largely bullish, driven by high spot metal prices and strong operational results currently.
Momentum.
In contrast, the forward-looking analyst valuations are cautious, weighed down by those unquantifiable but significant geopolitical risks. This suggests the market is currently in a momentum phase, rewarding current cash flow, while analysts are maybe more focused on the long-term threats to that cash flow.
Makes sense. Moving to Chapter 5, Ownership Structure. The composition of a company's shareholder base can provide valuable clues about market expectations and potential sources of stock price volatility.
It's particularly noteworthy how much of the company is owned by institutional investors, about 56% of shares. This shows professional interest, definitely, but the ownership is quite diffuse. There's no single controlling entity pulling the strings.
Right. And the largest identified institutional holders are major fund managers. Think VanEck, Vanguard, Fidelity. The prominence of these firms is significant because it suggests that a substantial portion of Pan American's ownership might be considered passive or formula-driven.
Index funds, maybe.
Exactly. This means the stock is often held not necessarily due to active conviction in its specific strategy, but because it's a large cap component of the major mining indices these funds track. This implies that Pan American's share price can be heavily influenced by broad capital flows into or out of the entire mining sector, independent of company specifics sometimes.
Interesting point. Insider ownership, on the other hand, is very low. Management and the board collectively own less than 1% of the company. Now, for a company of this size, low insider ownership isn't totally unusual, but it can sometimes suggest less skin in the game, meaning management's personal financial interest isn't as directly tied to share price performance as it might be with higher ownership. An examination of recent insider trading activity shows no open market buys or sells by key insiders over the past year, which is, well, a neutral signal. Doesn't tell us much either way.
Okay, let's now conduct a Chapter 6. Risk assessment using a SWOT analysis framework to summarize the key factors we've discussed.
And the central tension for Pan American Silver is incredibly clear, isn't it? Its formidable internal strengths and external market opportunities are directly threatened by severe and unpredictable geopolitical risks. It's almost like playing a high-stakes game of chess where the board keeps shifting under your feet.
That's a good way to put it. Let's start with the strengths. Pan American boasts a vast, diversified asset base. A large portfolio of long-life mines across the Americas, which reduces single-asset risk. It also has a world-class silver endowment, providing a premier platform for silver price exposure.
Right, the name isn't totally wrong.
No, exactly. Financially, it's a fortress. Exceptionally strong balance sheet, low debt, high liquidity, and robust free cash flow generation in the current environment. Finally, it has proven operational execution, demonstrating an ability to control costs and effectively integrate large acquisitions like Yamana.
Okay, turning to the weaknesses. We see volatile and historically low return on invested capital. It's been inconsistent, often below the cost of capital, indicating periods of maybe inefficient use of shareholder funds. There have also been M&A missteps. That costly and still unresolved Tahoe Escobal acquisition serves as a major blemish on management's track record. Billions tied up in unproductive
It's
capital.
a big question mark.
And mining, despite improvements, is inherently dangerous. Those two tragic fatalities in 2024 highlight the persistent risk of accidents. You can't forget that.
No, you can't. As for opportunities, the strong precious metal cycle continues to drive high prices for gold and silver, fueled by inflation, geopolitical tensions, structural investment, and industrial demand. There are high-impact growth catalysts in their portfolio, that massive La Colorada skarn discovery, the new stake in the low-cost Juanicipio mine, and the potential, though uncertain, restart of the world-class Escobal mine. Any one of those could be huge.
Game changers, potentially.
Potentially. Additionally, favorable Argentine reforms with a more pro-mining government are improving the outlook for their Cerro Moro mine there.
But the threats, this is where the true challenge lies. The single greatest threat is crippling geopolitical and regulatory risk, period. In Mexico, a hostile government has implemented policies that create, frankly, an existential risk for the company's most important assets there.
It's severe.
In Peru and Guatemala, political instability and complex community relations create an unpredictable operating environment. Beyond politics, there's commodity price volatility. The company's record profitability is a direct function of peak metal prices, which are historically volatile and may not be sustainable.
How it goes up.
Exactly. Finally, increasing ESG and social license pressures can lead to costly operational delays, permit challenges, and reputational damage.
So really, an investment in PAAs is an explicit bet. It's a bet that its operational excellence and world-class assets can overcome the profound challenges posed by the political environments in which it operates.
Okay, let's move to Chapter 7, Conclusion. This deep dive reveals Pan American Silver at a critical juncture, defined by a stark contrast between its exceptional performance and the severe external risks it faces. The investment thesis really hinges on whether its powerful growth catalysts and operational strengths can outweigh the profound uncertainties of its operating jurisdictions.
The bull case is compelling, no doubt. It's grounded in the company's current performance and future potential. Pan American is financially robust, a large-scale precious metals producer with a world-class silver reserve base. offer significant leveraged exposure to a strong precious metals bull market.
Leveraged is key.
Very key. It's generating record levels of free cash flow, allowing it to self-fund growth while rewarding shareholders through that transparent cash-linked dividend and an active buyback program. Its future is underpinned by multiple high-impact growth catalysts, La Colorado Skarn, Juanicipio, potentially Escobal. And from a valuation perspective, the stock appears inexpensive relative to its own history, suggesting the market might be overly pessimistic.
But the bear case offers equally potent arguments, centering on risks largely outside the company's control. Its future is effectively held hostage by extreme and unpredictable geopolitical risk, especially in Mexico, its most critical jurisdiction. A hostile government has implemented policies that could permanently impair the value of its key assets there. That's the fear. The company's record profitability is a direct function of peak commodity prices, which, as we said, are historically volatile, maybe not sustainable. Furthermore, management's M&A track record is mixed. The costly, unresolved Escobal situation serves as a major cautionary tale. From this perspective, the stock's low valuation isn't an oversight. It's a rational market discount for an unacceptably high level of risk.
Right. And as we discussed in the financial analysis, an educational discounted cash flow model would produce a wide range of intrinsic values, highly dependent on the discount rate used to account for that geopolitical risk. The difference between these outcomes is entirely down to an investor's subjective assessment of the political risk in Latin America. How much risk are you comfortable with?
So, comparing the current share price to the plausible range of intrinsic values, Pan American Silver presents a complex investment case. It's not a straightforward value or growth story. It's really more of a special situation. An investment in PAAS is a direct bet that management can successfully navigate severe geopolitical headwinds and that the current strong precious metal cycle will persist.
And the outcome, realistically, will likely be binary, driven by political events just as much as by operational performance.
So let's briefly look at the potential scenarios. Our base case might be sideways trading. Metal prices remain elevated but stable, production meets guidance, the political situation in Mexico remains uncertain but doesn't escalate to, say, asset seizure. The stock generates strong cash flow, but the share price remains range-bound, held back by that persistent geopolitical risk discount.
Muddling through.
The bull case involves a significant re-rating. Precious metal prices continue to rise, the MEG Silver Juanicipio deal integrates smoothly, and maybe a positive resolution emerges in either Mexico or Guatemala regarding regulations or Escobal. A resolution of a key geopolitical risk could remove that discount, leading to a sharp upward move.
That's the hope.
Finally, the bear case is a severe decline, a sharp correction in gold and silver prices, perhaps. Or the government of Mexico takes direct punitive action against Pan American's concessions. Or maybe a major operational failure at a key mine. This scenario would confirm the market's worst fears, leading to a dramatic fall in the share price. So given the stark contrast between PAAS's assets and its risks, the question for you is, how much are you willing to pay for certainty in an inherently uncertain world? If you enjoyed this deep dive, please like and subscribe to the 1 Tree Ounce YouTube channel. We cover all mining companies there, and we do take requests for stocks in the precious metal space.
And please remember, this analysis was generated by an AI system for educational purposes and should absolutely not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions.